Hi there, it's Ron Gula from Gula Tech Adventures, and today we're going to talk about different types of fundraising you can do when you're raising money from venture capital organizations. So my background, I'm a cybersecurity investor, former NSA. I helped co-found and ran Tenable Network Security, which went public. Now I run Gula Tech Adventures, which does cybersecurity investing seed through A. I've been involved with several $billion of investments and acquisitions in the cybersecurity industry. But what I'm going to say today is applicable to anybody who's raising money. So when you raise money for a startup, you're typically either going to be having investors buy stock or raise it from a loan that will convert to stock in the future. An example company here, maybe you start a company, you issue yourself stock, maybe you run some friends and family rounds and you get loans from people they don't own stock on your company yet. But then as people start to invest, you will be selling stock in your company, and those loans will convert to that. You can do this all the way up to an initial public offering on the NASDAQ or the New York Stock Exchange. Not everybody goes public. Perhaps you're going to raise some money from friends and family, do some more loans, maybe do an A round. Maybe you're going to do some more loans after that. There's a lot of reasons why you might do loans versus a direct stock raise. And maybe somebody acquires your company and you don't go public. So these things can happen. But for a real basic level, just to get started, let's say you and a friend start a company and you issue yourselves 1 million shares. It's great. You have 1 million shares of a company. Maybe it's worth a penny each share. It's not really a liquid investment, but somebody comes along and they want to buy 10% of your company. So you and your co-founder, you sell them 100,000 shares, and they now own 100,000 shares in that company. Your 900,000 shares that are left are now worth $9 million on paper, so to speak. And nobody does this, right? And the reason why nobody does this is because you don't want to sell your shares. Your company wants to sell shares. So this is an example. I always start out with first-time founders, first-time fundraisers to understand these concepts of company dynamics. Now, you don't want to sell your shares because you don't want the money to invest in your company. You want your company to get that. So how does this happen? You have 1 million shares. Somebody wants to buy maybe 100,000 shares of your company at $10 a share. Your company would then issue new stock. Now, this would imply that the stock price of your company is $10 a share, that the 1 million shares you have are worth $10 million, and that you would own 91% of your company. You'd basically own 1 million shares of the 1.1 million out there. That's a fraction. 1 million you own. The total number of shares is 1.1 million, and so on. Now, when you do these kind of loans, though, it's not always a direct stock purchase like that, because maybe you can't agree on that price. Maybe you don't know how to value a startup, like you're curing a disease, you're creating an infinite battery, a perpetual motion machine, and we don't know how to value that. And at the same time, we also don't really want to be in a situation where, if we don't know how to value your company, well, then how do we value a future success rate? What's the upside for us? So the venture capital, various financial institutions have come up with a variety of models and structures to invest. And these are called convertible notes or SAFEs. Basically, these are loans that have a certain interest rate and a certain set of rules to convert to stock at some point in the future. So for example, maybe in 3 years it'll convert, maybe under acquisition of a company it'll convert, or maybe when there's a new value setting investor, such as we described before, where somebody's willing to come along and do this. Now there's two types. There's one that's just a straight discount that says at some point in the future, we're going to give you a discount on the stock. And there's another one that says, look, we'll give you a discount, but we also are setting a value for our company. And if we blow it out of the water and create the next Tesla or the next, amazing pharmaceutical company, we're going to give you some upside on that. And this is how it works. Real basic example. Let's say we get a loan for $100,000, 20% discount, 8% interest. And then 2 years later, a new investor comes in and they say, look, we're willing to buy stock in this company at $40 a share. Great. You take that $100,000, you compute the interest on that for 2 years, which is $117,000. We know we can buy stock at a discount, 20%. 20% discount, 80% of 40 is 32. Well, I take my $117,000. I buy all of that stock I can for $32 a share, and that's 3,645 shares. If you take that, multiply it times 40, you get $145,000. So on paper, you can think about it as an investor, I've invested $100,000 in a company, and on paper, it's worth $145,000. And that's how a basic convertible note works. But imagine again what happens if somebody says, look, I think you guys might be the next Tesla, the next amazing company. I am not sure what to value you though, but I do want to have some upside just in case you do that. One of the terms you can agree upon is a conversion cap, a valuation cap. And in this case, let's just say, for example, it's $30 million. Which basically what this says is at some point in the future, we're going to look at the stock that's been out there and we're going to figure out, is it a better deal as an investor to invest at the 20% discount or to look at that valuation cap? And this is the way we compute that. So 2 years later, let's say somebody comes along and says it's the same deal and it's a $40 a share stock purchase, but the company's also worth $100 million. Now, this is new information, right? So the conversion cap, we have to take into this account. Now, if you remember previously, the stock that we were buying with the note was 20% discounts on 40, it was $32 a share. However, with the cap, you basically take the conversion of the fraction of the valuation cap with the new valuation, use that as your percentage, and you figure it out. Now, in this case, 30 over 100 million is a $12 a share price. Now, that's a much better deal than $32 a share. As a matter of fact, at $12 a share with our accumulated interest, we can buy almost 10,000 shares in this company. It's worth $389,000. Now, as an investor, you might want to ask this because you're basically saying, look, in the future, if you guys kill it, we are still willing to invest in you, but we want some more upside on that. It's a very interesting conversation. Now, these things are always negotiable. Companies who are selling stock, they talk to a lot of different investors, and there's actually a lot of subtle variations on this. Like, you got to read the fine print. Is interest computed annually, monthly? Are there caps on this? Is that money valuation? Is it pre-money or post-money? That this can make a big swing, believe it or not, in there. And then, you're going to find maybe some investors who only invest in stock. If you are a stock owner, there's a lot of tax reasons why you want to own stock and not do lending, but there's all types of folks that are out there. So I hope everybody is now an expert on different vehicles for raising capital. If you enjoyed this video, please subscribe to this YouTube channel, not only for venture capital and business tips, but cybersecurity as well. I'm Ron Gula. Have a great day.